In 2024, the world produced 820 million ounces of silver. Mexico led with 186 million ounces. China added 119 million. Peru contributed 111 million. Together, these three nations supplied 51% of global mine production. But here's what most people don't understand. The countries that mine the metal don't actually control the supply. Because silver production isn't like oil or copper. It's not a primary business for anyone except a handful of companies. It's a byproduct, an afterthought, a consequence of mining other metals. And that structural reality creates a control mechanism more subtle and more powerful than any government monopoly or mining cartel. The world's silver supply is controlled by forces that have nothing to do with silver itself. Base metal prices, industrial decisions made in copper and zinc boardrooms, and increasingly by institutions that haven't mined an ounce in their lives but hold more metal than entire nations produce in years. Let me show you exactly who controls the world's silver supply. Not who mines it, who controls it. The mining companies, the base metal producers, the refiners, the exchanges, and the silent accumulators whose positions dwarf everything else. Because understanding control isn't about production numbers. It's about understanding the structure of the market itself. And once you see that structure, you'll realize the world's silver supply is controlled by a system more concentrated, more opaque, and more vulnerable to disruption than almost any commodity on Earth. Start with the obvious. Who mines silver? In 2024, according to the World Silver Survey published by the Silver Institute, global mine production reached 820 million ounces. That's up just 0.9% from 2023, nearly flat. And that flatness tells you everything about who really controls supply. Mexico remained the world's largest producer at 186 million ounces. That's 23% of global output. The major mines, Fresnillo's operations, Newmont's Peñasquito, Juanicipio, these are the facilities generating hundreds of millions of ounces annually. But here's what matters. Mexico's production isn't growing. In fact, from 2016 to 2024, Mexican silver output declined 7%. The easy silver is gone. Ore grades are falling. The mines that remain are deeper, more expensive, less profitable at current prices. China sits in second place at 119 million ounces, roughly 15% of supply. But Chinese production is also stagnant. Most of China's silver comes as a byproduct from lead and zinc mines. When zinc prices are weak, those mines slow down. Silver production falls with them. Peru holds third position at 111 million ounces, about 14% of global supply. But Peru faces constant disruptions, community disputes, government conflicts, environmental protests. In recent years, major operations like Cerro de Pasco have faced temporary closures. Production is unreliable. Together, these three nations supply 51% of the world's silver. That sounds concentrated, except it's not, because none of these countries control their silver output. The companies do. And the companies don't control it either. The base metal markets do. Here's the structural trap. Only 28% of global silver comes from primary silver mines, operations where silver is the main product. That's 227 million ounces in 2024, according to the Silver Institute. The remaining 72% is byproduct silver. It comes from lead and zinc mines, copper mines, and gold mines. Lead and zinc operations provided the largest share, roughly 45% of total silver supply. But here's the problem. Lead and zinc miners don't make money on silver. They make money on lead and zinc. Silver is a bonus, a credit against costs, but not the reason the mine exists. When lead prices are low, zinc prices weak, those mines cut production. They slow operations. They delay expansions. And silver output falls. Not because silver demand dropped, not because silver prices crashed, but because base metal economics don't justify continued production. This means 72% of the world's silver supply is controlled by the profitability of other metals. Copper, zinc, lead, gold. Industries where silver is an afterthought, a byproduct line on the quarterly earnings report. That's the first layer of control. The metal itself is subordinate to other markets. And when those markets weaken, silver supply contracts, regardless of silver demand, but it gets more concentrated. Because while dozens of countries mine silver, a handful of companies control the actual production. Fresnillo plc is the world's largest primary silver producer. In 2024, the company operated 7 mines in Mexico, producing approximately 54 million ounces. That's 7% of global supply from one company. Pan American Silver is the second largest, with operations across Mexico, Peru, Canada, and Bolivia. Combined production around 25 million ounces annually. KGHM Polish Copper, operating in Poland and Chile, produces roughly 43 million ounces of silver annually as a byproduct of copper mining. That's 5% of global supply. These 3 companies alone control approximately 15% of the world's annual silver production. Add the next 7 producers, companies like Newmont, South 32, Coeur Mining, Polymetal, Hecla, and you're looking at roughly 40% of global supply controlled by just 10 corporate entities. That's concentration, not government control, corporate control. And here's what matters about corporate control. It responds to profit, not demand. In 2023, when silver prices averaged around $23 per ounce, multiple mining companies delayed expansion projects. Fresnillo pushed back development timelines. Pan American Silver slowed exploration spending. Why? Because at $23, new projects don't generate sufficient returns to justify the capital expenditure. So even when demand was rising, supply didn't respond. The companies that control production chose not to increase output because the economics didn't work. This is fundamentally different from oil or copper, where supply responds relatively quickly to price signals. In silver, the byproduct nature and the corporate decision-making structure create a supply response that's slow, inflexible, and often inverse to what you'd expect. Now let's talk about the next layer, refining. Because mining silver is one thing, turning it into deliverable bars is another, and that's where control gets even more concentrated. There are maybe 20 major silver refiners globally that process the majority of mined silver into the 1,000-ounce bars used for investment and the various forms needed for industrial applications. The Swiss refiners, Heraeus, Metalor, Valcambi, dominate this space. They process silver from multiple mines, blend it, refine it to the required purity, typically 999 or 9999 fine, and cast it into standardized bars. These refiners act as gatekeepers. Mines produce doré bars or concentrates containing silver mixed with other metals. Refiners separate the silver, purify it, and deliver finished product. Without refining capacity, mined silver can't enter the market in usable form. And here's where it gets interesting. Refining capacity is limited. It takes years to build a new refinery, billions in capital investment, environmental permits, skilled labor. You can't just spin up new capacity overnight. In recent years, refiners have reported extending delivery times. What used to take 2 weeks from order to delivery now takes 6, 8, even 12 weeks in some cases. Why? Because demand for refined silver is outstripping refining capacity. The refiners themselves have admitted in industry publications that they're operating near maximum capacity. They're scraping for feedstock. They're bidding up prices for scrap and secondary material, and they're telling mints and industrial users that delivery schedules are stretching. This creates a bottleneck. Even if mines produce more silver, if refiners can't process it fast enough, supply to end markets gets constrained. The refiners, by virtue of their infrastructure monopoly, control the flow of silver from mine to market. Now let's talk about the layer most people never see. The exchanges. COMEX in New York and the London Bullion Market Association, LBMA, are the 2 dominant price-setting venues for silver. Between them, they handle the vast majority of silver trading, both physical and paper. COMEX silver futures are the benchmark for global silver prices. Every day, thousands of contracts trade, each representing 5,000 ounces of silver. The vast majority of these contracts are settled in cash. They never result in physical delivery. They're purely financial instruments used for hedging, speculation, and price discovery. But some contracts do stand for delivery, and when they do, COMEX must deliver physical silver from approved warehouses. As of late 2024, COMEX held approximately 291 million ounces of silver in total across all approved warehouses. That sounds like a lot, except only 47 million ounces were classified as registered, meaning available for immediate delivery against futures contracts. The remaining 244 million ounces were eligible, meaning they meet COMEX specifications and are stored in approved warehouses, but they're not available for delivery unless the owner chooses to register them. This distinction is critical. COMEX's deliverable supply is not 291 million ounces. It's 47 million ounces. That's barely 2 months of global production. And it's roughly 4% of annual demand. Now think about that. The exchange that sets the global price for silver holds only 47 million ounces available for delivery. Meanwhile, annual demand is 1.16 billion ounces. If even a small fraction of futures holders demanded physical delivery simultaneously, COMEX couldn't fulfill the orders without pulling eligible metal onto the market. This creates a control mechanism. COMEX, by virtue of holding the exchange infrastructure and the warehousing system, effectively controls the marginal supply of immediately available silver. They don't own it, but they control the logistics, the rules, the delivery process. And when stress appears, when delivery demands spike, COMEX has historically responded by changing the rules. In 1980, during the Hunt Brothers silver squeeze, COMEX implemented position limits and changed margin requirements specifically to break the squeeze and force liquidation. They can do it again. And that ability to change the rules when physical demand threatens paper market stability gives the exchange operators enormous control over the silver market. Meanwhile, in London, the LBMA operates differently. It's not a futures exchange. It's a network of vault operators and dealers who trade physical silver and facilitate over-the-counter transactions. The LBMA reported roughly 827 million ounces of silver in London vaults as of December 2024. But here's the catch. According to market observers, approximately 551 million ounces of that total is reportedly backing silver ETFs, like the iShares Silver Trust, SLV. That leaves about 276 million ounces of what's called the float silver available for commercial trading. Except even that 276 million ounces isn't fully available. Much of it is held by long-term investors, institutions and entities that have no intention of selling unless prices spike dramatically. The actual liquid supply in London, the silver that could be mobilized to meet delivery demands, is likely far smaller than 276 million ounces. How much smaller? Nobody knows. The LBMA doesn't publish how much is truly available versus locked away in long-term holdings. This opacity gives the vault operators and major dealers enormous power. They see the flow, they know who's buying, who's selling, who's taking delivery, who's desperate for metal. That information asymmetry allows them to position ahead of market moves. And when physical tightness appears, when lease rates spike, when delivery delays extend, the LBMA members are the ones who decide whether to lend metal, sell from inventories, or tighten supply further. This is control by infrastructure. The exchanges don't mine silver, they don't refine it. But they control the mechanisms through which silver flows from producer to end user. And that control gives them power over price, availability, and market function. Now let's talk about the silent layer, the accumulators, the entities that have quietly built positions so large they dwarf entire nations' annual production. ETFs like the iShares Silver Trust SLV hold approximately 551 million ounces as of late 2024. That was more silver than Peru and Bolivia produce combined in an entire year. And SLV is just one ETF. Add the Sprott Physical Silver Trust, various European silver ETFs, and you're looking at over 600 million ounces held by passive investment vehicles. These ETFs don't trade, they don't lend metal, they just hold. Their mandate is to provide investors with exposure to silver price movements by holding physical metal in vaults. And every day they hold, that's 600 million ounces removed from the commercial market. But the real concentration, the position that should terrify anyone paying attention, sits in vaults controlled by one institution. Reports from industry sources and market observers suggest that JP Chase has accumulated somewhere between 675 million ounces and over 1 billion ounces of physical silver over the past 14 years. If the higher estimates are accurate, that's 9% of global above-ground supply, held by one bank. Let that sink in. One institution, one bank, potentially holds more silver than exists in all COMEX warehouses, all LBMA vaults, and all silver ETFs combined, and they've accumulated it quietly, steadily, over more than a decade, while silver prices were suppressed below $30 per ounce. That's not a position, that's control. Because when one entity holds 9% of a commodity's above-ground supply, they don't just influence price, they set it. If JP Morgan decided to lend metal, lease rates would collapse. If they decided to withdraw metal from the market, lease rates would spike, delivery would tighten, and prices would surge. They don't need to do anything. The mere existence of that position changes how the market functions. Every trader, every dealer, every industrial user knows that JP Morgan is sitting on this hoard, and that knowledge influences behavior. People are less willing to short silver aggressively. They're less willing to bet on price declines. Because if JP Morgan ever decides to squeeze, if they ever demand delivery against paper positions, they could break the market. This is the ultimate control. Not mining, not refining, not even exchange infrastructure. Ownership, concentrated, undisclosed, strategically accumulated physical ownership. Now, let's talk about why this concentration exists. Because silver has a unique characteristic among commodities. It's consumed, oil gets burned, but new oil wells get drilled. Copper gets used in buildings and wiring, but when those buildings are demolished decades later, the copper gets recycled. Gold almost never gets consumed. It sits in vaults, in jewelry, and central bank reserves. Essentially, all the gold ever mined still exists in some form. But silver? Silver gets consumed. It's used in tiny amounts in electronics, solar panels, batteries, medical applications. When you throw away a phone, the silver inside is often uneconomical to recover. When a solar panel degrades after 25 years, the silver is often lost to landfill. According to the Silver Institute, recycling rates for electronics hover around 18%. That means 82% of silver used in electronics is never recovered. It's consumed, gone. removed from the above ground supply permanently. This creates a structural deficit. Annual demand in 2024 reached 1.16 billion ounces. Annual supply, mining plus recycling, totaled about 1.01 billion ounces. That's a deficit of 150 million ounces. And this isn't temporary. This is the fourth consecutive year of structural deficits. From 2021 to 2024, cumulative deficits reached 678 million ounces, according to the Silver Institute. That's nearly 10 months of global mine supply consumed beyond what was produced. Where did that 678 million ounces come from? It came from above-ground stockpiles, vaults, inventories, reserves accumulated during previous years when supply exceeded demand. But those stockpiles are finite. They're being drawn down. And at some point, if deficits continue, they run out. This is why control of existing stockpiles matters so much. The entities that hold large inventories, JP Morgan, the ETFs, the exchanges, are sitting on a depleting resource. Every year, industrial demand consumes more silver than mines produce. Every year, the available supply shrinks, and as it shrinks, the control held by those who own existing stockpiles grows stronger. Let me show you the timeline. In 2021, COMEX warehouses held roughly 400 million ounces. By early 2024, the figure had dropped to 280 million ounces. That's a 30% decline in 3 years. The metal was withdrawn, delivered against contracts, moved to private storage, consumed by industry. London vaults held over 900 million ounces in 2020. By December 2024, that figure had fallen to 827 million ounces. That's 73 million ounces drained from the system in 4 years. The inventories are falling, the deficits continue, and the concentration of remaining supply in fewer hands grows tighter. This creates a dangerous dynamic. The people who control silver supply today, the mining companies, the refiners, the exchanges, the accumulators, they're controlling a shrinking pool. And as the pool shrinks, their leverage increases. Now let's talk about industrial demand, because the consumption side of this equation is what makes the supply control so powerful. In 2024, industrial demand for silver reached 680 million ounces, a record high for the fourth consecutive year. That's 59% of total demand, and it's growing. Solar panels are the biggest driver. Each panel requires roughly 20 grams of silver for the conductive paste that allows electricity to flow. Global solar installations surged in recent years. In 2024 alone, installations hit record levels. And every gigawatt of new solar capacity requires roughly 100,000 ounces of silver. The International Energy Agency projects solar installations will continue growing at 10 to 15% annually through 2030. If that happens, industrial demand from solar alone could reach 200 million ounces annually within 5 years. Electric vehicles are the second major growth area. A traditional internal combustion vehicle uses roughly 15 grams of silver. An electric vehicle uses 30 to 40 grams. As EV production grows, silver consumption grows with it. Then there's electronics, 5G infrastructure, AI data centers, medical devices, electrical contacts, batteries. Every modern technology relies on silver's unique properties. Highest electrical conductivity of any element, highest thermal conductivity, antibacterial properties, reflectivity. There's no substitute for silver in most of these applications. Not at current performance levels. You can't replace silver in solar panels without reducing efficiency. You can't replace it in electronics without sacrificing reliability. This creates inelastic demand. Industrial users need silver. They'll pay higher prices if necessary. They'll accept longer delivery times. They'll stockpile when possible. But they can't stop buying. And when demand is inelastic, the people who control supply have pricing power. They can withhold metal. They can extend delivery times. They can demand premiums. Because buyers have no choice but to pay. This is the mechanism through which concentrated control translates into market power. The mining companies, the refiners, the exchanges, the accumulators, they're not just holding silver. They're holding the supply of an irreplaceable industrial input with growing inelastic demand. And that gives them leverage over the entire industrial economy that depends on silver. Now let's talk about what happens when the control structure breaks down. Because concentrated control creates fragility, and silver's control structure is more fragile than it appears. The base metal dependence means silver supply can collapse even when silver demand is strong. If copper prices crash, copper mines shut down. Byproduct silver production falls. The 72% of supply that comes from lead, zinc, copper, and gold mining disappears or contracts sharply. This happened in 2023 when zinc prices weakened. Multiple zinc mines in South America faced temporary closures due to community disputes and weak economics. Silver byproduct from those mines vanished. Total global silver production fell 1% that year, despite silver prices holding steady. Imagine a scenario where base metal prices enter a sustained bear market. Copper falls to $3 per pound. Zinc drops to $1 per pound. Lead follows. The mines that produce 72% of the world's silver become unprofitable. They close, they go into care and maintenance. Silver production could drop 30, 40, even 50% within 2 years. Not because of anything happening in silver markets, but because base metals crashed and took silver supply with them. Meanwhile, industrial demand wouldn't fall. Solar installations continue. EVs keep getting produced. Electronics manufacturing doesn't stop. Demand stays at 1.16 billion ounces. But supply collapses to 600 or 700 million ounces. The deficit would explode. Inventories would drain in months, prices would spike, and the entities controlling remaining stockpiles, JP Morgan, the exchanges, the major refiners, would have absolute pricing power. That's the fragility. The control structure depends on base metal markets staying healthy enough to justify continued silver byproduct. If those markets break, silver supply breaks with them. The second fragility is refining capacity. If major refiners face disruptions, supply chains break. In 2024, several refiners reported operating near maximum capacity and extending delivery times. They're already stretched. Any additional stress, equipment failure, labor strike, regulatory shutdown could create immediate shortages. And building new refining capacity takes years. You can't just flip a switch and create new refiners. By the time new capacity comes online, the shortage could persist for years. The third fragility is exchange inventory. COMEX registered silver sits at 47 million ounces. That's barely enough to cover 2 months of futures deliveries at normal rates. If delivery demands spike, if even 10% of futures holders stand for delivery instead of the typical 2 to 3%, COMEX faces a squeeze. They can change the rules. They did it in 1980. But changing rules destroys confidence. If COMEX proves unable or unwilling to deliver against futures contracts, the price discovery mechanism breaks. The exchange loses credibility, and physical silver trades at massive premiums over paper silver. This already happened briefly in 2020 during the COVID panic. Physical silver coins were selling for 12 to 15 over spot price because supply chains broke and dealers couldn't source metal. That premium lasted months, and that was a temporary disruption. Imagine a sustained squeeze. Paper silver at $30, physical silver at $50. The divergence would prove that paper markets are fractionally reserved, that the claims on silver far exceed available metal, and confidence would collapse. That's when control shifts entirely to physical holders. The miners, the refiners, the accumulators. Paper contracts become worthless. Only physical metal matters, and the entities holding physical dictate terms. This is the ultimate consequence of concentrated control combined with structural deficits and inelastic demand. The system is stable until it's not, and when it breaks, the breakdown is catastrophic for anyone not holding physical metal. Let me show you who wins and who loses when control becomes absolute. The entities holding physical silver, JP Morgan, mining companies with stockpiles, refiners with inventory, they win. When supply is exhausted and prices spike, their holdings multiply in value. If silver goes from $30 to $100, JP Morgan's position could increase from $30 billion to $100 billion. That's $70 billion in gains. Not from mining, from accumulating and holding. Industrial users with secured supply contracts win. Companies that negotiated long-term delivery agreements at fixed prices can continue production, while competitors scramble for metal at spot markets. This is why major electronics manufacturers and solar companies are increasingly signing multi-year supply agreements with miners and refiners. The entities that lose are the ones dependent on paper markets and just-in-time inventory systems. Manufacturers without secured supply. Investors holding silver ETFs that are fractionally reserved or backed by questionable inventory. Traders short silver futures who face delivery squeezes, and consumers lose. Because when silver prices spike, the cost gets passed through. Solar panels become more expensive, electronics cost more, vehicles increase in price, medical devices see price hikes. The control of silver supply isn't just an academic question. It determines who can operate, who survives, and who thrives in an economy increasingly dependent on silver-intensive technologies. Here's the reality. The world's silver supply is controlled by a handful of entities operating at different layers of the market. Mining companies control less than you think because 72% of supply comes as a byproduct. Refiners control the flow from mine to market through infrastructure monopolies. Exchanges control price discovery and delivery mechanisms, and silent accumulators, particularly JP Morgan, control vast stockpiles that dwarf annual production. This concentration is increasing as structural deficits consume above-ground inventories. The control is opaque because the largest positions aren't publicly disclosed, and the system is fragile because it depends on base metal economics, refining capacity, and exchange credibility. When any of these layers fails, control becomes absolute. The physical holders set the price, the industrial users pay whatever is demanded, and the paper market collapses. You can't escape this. If you use electronics, drive a car, benefit from solar power, or depend on modern medical technology, you're exposed to silver supply dynamics. The entities that control silver control a piece of the infrastructure that makes modern life possible. And right now, that control is more concentrated than at any point in the last 50 years. If this showed you a structure you'd never seen before, if you understand now that silver supply is controlled not by countries, but by corporations, refiners, exchanges, and strategic accumulators, then you need to see what happens when that control structure faces its ultimate test. Because while we've talked about control, we haven't talked about what happens when a single bank has quietly accumulated enough silver to squeeze the entire market. When one institution holds a position so large, it could trigger the kind of supply shock we've been discussing. There's a video on this channel that breaks down how JP Morgan quietly built a silver stockpile between 6 and 75 million and over 1 billion ounces across 14 years, potentially 9% of global above-ground supply. It covers the manipulation charges, the delivery strategy, the timeline, and why this accumulation may be the most important signal in the silver market today. Watch that next. Because understanding who controls supply is one thing, understanding who holds the position that could break the control structure is another. The world's silver supply is controlled by fewer entities than you think, and the concentration is accelerating. Welcome to the silver market, where control is everything, and the controllers are few.